With so many options and financial lingos and definitions that require additional explanation, picking the right funds for you can be a daunting and intimidating task. My 401k plan has 31 funds to choose from. Yours may be more or less. If these terms sound foreign to you, fear not. By the end of this episode, you will be able to make an educated and informed decision on picking the right funds for you. Grab a popcorn or pop, or if you're a coffee drinker like me, fill up your coffee. Trust me, your return on time invested with this video is well worth it. Picking the wrong funds with high fees and underperforming the market can cost you as much as $621,000. That is a conservative estimate for a dual income household making $80,000 per year, contributing just 5% of your income, along with a 5% employer's match, invested for 35 years with a market return of 10%. Employer's match from companies to companies varies. Please consult with your human resource department and benefits department. If you're new to investing, I encourage you to watch it from the beginning to the end. And if you have some experience with investing, feel free to skip with the chapter markers below. In the investment page, you see a list of available funds to choose from with the naming convention that doesn't seem to make much sense at first glance, but I'm going to attempt to make some sense out of them. The fund's name typically consists of the abbreviated name of the company that created the fund, the types of funds, and the fund's objective. If it is a target date fund, it has a target year, and sometimes the suffix that signifies the class of the fund. Think of it as a vehicle trim level. The 5 letters in parentheses is the fund's ticker symbol. Think of it as a unique license plate number that you can use to do more research outside of your 401k plan, which we will do in the next episode. The inception date when the fund was created, it's either to the right of the fund's name or at the bottom. When you click the fund's name, you will see the full fund's description that is easier to read, understand, and remember. I am extremely sensitive to fees. Before I discuss other things, I want to go straight into the fees tab. The investment worlds call this expense ratio. It's an admission cost for you and me to participate and own pieces of the fund. It helps cover the cost for the managers and the infrastructures and to keep the lights on for the companies that created those funds. You pay these fees regardless if your funds are performing well or not performing well. A $10,000 investment with 1% fee will cost you $100 annually. A $10,000 investment with 0.04% fees will only cost you $4 annually. A $94 difference for a $10,000 investment may seem insignificant, but if you invest that, compound that over 35 plus years, that can be a sizable leak from your nest egg. You can use this calculator below to see what a small percent difference can make. Compound interest can work for you and against you. I'm okay with high fees as long as the fund's return minus the expense ratio is greater than the index, is greater than the passively managed funds. More on that later. Fidelity did a pretty good job grouping funds by their type of asset class and category. If you look at funds that invest in large cap stock, the lowest fees is 0.035%, and it goes as high as 0.8%. For the mid-cap stocks, the fees is as low as 0.04% and as high as 1%. For small cap, they are typically a lot higher, 0.51%, as high as 1.05%. International stocks, as low as 0.47%, as high as 1.01%. And the blended fund investment, which is typically the target date fund, they are as low as 0.08%, as high as 0.25%. The bond investment is as low as 0.035% and as high as 0.41%. Now that I get the pesky fees out of the way, let's go to the average annual return tab again. This 1 year, 3 years, 5 years, and 10 years LOF Life of Fund lists the fund's average annual total returns. The benchmark column gives you a quick comparison how the fund performs compared against the benchmark, aka the index, or other funds in the same category. I typically don't put much weight in the 1 year or 3 year return because of the natural market swings and the ever-changing macroeconomic. 1 year, Fund X outperformed Fund Y but the reverse is also true the following year. 5 to 10 years or life of the fund is a better indicator of the fund's historical performance, allowing you to see how stable or volatile the fund is for the last decade. Don't forget the hidden costs, the expense ratios. When you're comparing funds performance, make sure you calculate true return, which is funds performance annual total return minus expense ratios. If you look at the 1-year returns, most are doing well across the board. That's because the market has been hitting all-time high after all-time high. S&P 500 had 38 record close as of Tuesday, July 16th. 3-year return tell a different story, with most funds seeing single-digit returns and some seeing negative returns. Why? The initial pandemic put a blimp in the market. That's why I put more weight on a 10 years or life of the fund and the asset class that funds invest in. As a side note, most people in my previous line of work view me as a data guy, but they fail to understand that I look beyond the data. Data is only half the equation. You have to be able to relate that data to the real world. That applies to my previous line of work, and that applies to investing world. It's worth noting, as a disclaimer, past performance doesn't guarantee future performance, but it's still worth your time to look into how the fund performed historically, because that gives you a rough idea how the funds perform in the future. If you rely solely on historical data, it's like ESPN analysts trying to predict who will be the game winner or who will win the championship. It's entertaining, but I wouldn't put my paycheck on it. Under the asset class, look at what asset class is the fund invested in. Is it stock investment, also known as equity, bond investments, also known as fixed income, or blended investments, a combination of stocks and bonds? Each of the asset classes have their pros and cons. Understanding the traits and characteristics will allow you to choose what is best for you. Only you can decide what asset classes and their category align with your risk profile. Funds invested in stocks contain collections of publicly traded companies of different sizes and valuations. Stock investment can be further broken down and grouped by market cap, large cap, mid cap, and small cap, as well as international market. They have the use cases and downsides. Market cap is short for market capitalization. Market cap measures how much a publicly traded company is valued in the market's eyes, which is not the same as the actual equity or worth of the company. Companies in the same market cap have similar traits, characteristics, risk, and returns, but it is still a generalization. It is no different than an automobile. For example, a truck is a rugged vehicle that is great for hauling things around, but depending on the make, model, and trim level, one is more capable, reliable than others. As for brand value, some brands are more valuable than others due to their reputation or people preferences and emotional attachments. To calculate a company's market cap, you take shares outstanding times the price per share. Apple's market cap as of August 16, 2024, was $3.44 trillion. That's $1 trillion with a T. We derived to that number by taking 15.2 billion shares times $226.05 per share. In other words, as a public company, Apple has 15.2 billion shares or slices of its whole business for the retail investors, DIY like you and I, and institutional investors, company that research and provide the financial products for you and I to own. Benjamin Graham, the father of value investing, said, "In the short run, the market is a voting machine, but in the long run, the market is a weighing machine." Simply put, price per share is often based on people's feelings, emotions, rumors, and speculation, which may or may not align with the actual company's intrinsic value. But in the long run, the market is a weighing machine, which accurately aligns with the company's intrinsic value. Since we're talking about investing inside a 401k plan, you and I don't need to know about the nitty and gritty detail of a single company, because the funds manager, the institutional investors, will do the hard work for us. I'm only going the basic of how companies are valued in the market's eyes and how they are grouped into different market caps, so you have a pretty good understanding why different funds are grouped into different market caps. Generally speaking, large cap funds contains companies that are valued at $10 billion or more. Mid cap funds contains companies that are valued between $2 billion and $10 billion. Small cap funds contain companies that are valued at $250 million to $2 billion. Large cap companies are typically stable and less risky because they are typically at the top of their industry. However, the room for growth is somewhat limited unless they happen to be tech companies. Small cap companies have high potential for growth with inherent high risk. They are young companies that look to make an impact and grow the business. They can either turn into a business juggernaut, the next Amazon, the next Google, the next Apple, the next Netflix, or they can also bust and we never hear about them again. Mid-cap companies sit between the large cap and small cap. They are the best of both worlds. They are not yet at the top of the industry, but they are not your fly-by-night business either. So lastly, some funds invest in international stocks, companies outside the US. Financial experts suggest having some exposure to international market to mitigate the risk, as the international market typically moves different direction than the US stock market. Target date fund do have international stocks as part of their asset allocation. Most bond funds inside a 401k plan aim to preserve income by investing in a collection of investment-grade government and corporate bonds with credit ratings of BBB or better, BBB, A, AA, and AAA. If you see high yield bond fund either in the name or with higher yield than usual, most likely it contains below investment grade bonds with credit ratings of BB or lower. You can find information under the fund strategy and credit quality under composition. You get a higher yield because of the bond's issuer's credit risk. Bonds yield is similar to your interest you pay on a loan. If you have an excellent credit score, you get the loan at a much lower rate than someone with an average or poor credit score, who may have a higher risk of defaulting on their loans. Bonds performance is sensitive to interest rate changes. The longer the terms, the more sensitive it is to interest rate change. Since bonds typically move in a different direction than stocks, and it is a stable and fixed income, experts suggest using bonds to diversify your portfolio. However, percentages varies depending on your risk profile. You certainly don't want to have it too early in your investment journey. Even though 401k fund doesn't have individual bonds inside it, I just want to go over quickly what a bond is. A quick cliff note: corporations and government issue bonds to borrow money from a pool of investors to fund their projects and initiative. It is an IOU in a contract form as a bond note. For example, Company X may issue a bond of $10,000 with a 3% coupon rate, we know it as interest, for 10 years. If you buy that note, you lend Company X $10,000. In return, you get $300 per year in interest for over a 10-year period. Once the 10 years is over, you get your initial $10,000 back. Everything in life has risk. Bond is no different. When you buy individual bond, you may run into companies going bankrupt, companies going belly up, and you may not get your initial $10,000 back. However, bonds fund's default risk inside of 401k is very minimal because it invests in a collection of high-grade corporate and government bonds, not just one single company. Blended investments have stocks and bonds for those looking for growth and income. Target date funds fall under the blended investment. Even though I went over target date fund in the previous video, I'm still going to touch base on it again in this video because it's a common suggested fund for most people to set it and forget it. A target date fund is a diversified fund with the proper US stocks, international stocks, and bond allocation based on your desired retirement year. It plays offense during your wealth accumulation years further from the target date by leaning towards a higher percentage in stocks. As it approaches the target date, wealth preservation years, it emphasizes more defense, leaning towards more bonds. To illustrate how the target date funds operate, I have compared the stocks to bond ratio for different target years in my 401k plan. This is for demonstration purpose only, and the percentage may vary slightly over time. Your plan may have different stocks and bond allocation for different target year. The allocation for target 2025 is 52.9% in stocks, 31.48% in US stocks, and 21.43% in non-US stocks, and 47.09% in bonds. The funds lean heavily towards stock when the target year is further out. For target 2045 and beyond, the allocation is 90.13% in stocks, 53.63% of which is in US stocks, and 36.5% in non-US stocks, and 9.87% in bonds. 2045 and beyond, they have the same allocation. That's because the time horizon is over 14 years out. But shorter than that, different target years does have different allocations. Instead of giving blind advice like I have seen on some of the financial influencers, not all target date funds are created equal. Depending on the size of your company and the fund provider, you may have target date fund with the same target year, but have a different stock to bond ratio and higher expense ratio. To prove the point, I will show you two different target date funds from two different fund providers. Fidelity Freedom Index stock to bond ratio is more conservative with only 0.08% in expense ratio. On the other hand, Fidelity Freedom Blend is a little bit more aggressive with a stock to bond allocation, charging a bit more in expense ratio of 0.25%. Fidelity Freedom Blend has a slightly better performance, but when you factor in the difference in fees, 0.08 versus 0.25%, the net return is almost negligible. When comparing funds in the same asset class and group, you need to look at the average return minus the fees. I'm not against fees, as long as additional fees add additional noticeable value to me. If Fund X charges a 1% fee with 11.5% return, and Fund Y charge 0.04% fee with 11% return, as an investor, Fund Y is more advantageous for me when factoring in the fees. Not to mention, you get charged these set of fees yearly regardless of the fund's performance. In the investment world, you have two different camps. You have one that says invest in index fund, just ride the market, set it and forget it. There's nothing better than having funds with low fees. And then you have another camp that says invest in actively managed fund, high growth funds that outperform the index any day. To me, I don't pick sides. I just look at facts. I look at the historical rate of return minus the expense ratio, and I look at what funds are available to me. As you look through the funds, see if the funds is actively managed or is it passively managed. Actively managed funds has a manager or a team of manager attempting to beat the market, attempting to beat the index. Whereas passively managed fund is simply tracks and mimic the index, matching the market returns. Speaking of index, what is index? There are thousands of US market indexes across market caps and sectors. However, the media typically cover these top three: S&P 500, Dow Jones Industrial Average, DJIA, and NASDAQ Composite. The S&P 500 index comprises the top 500 US publicly traded companies by market cap. They include companies we all know and love: Apple, Microsoft, Nvidia, Google, Amazon, Meta, Tesla, Starbucks, etc. Apple, with the ticker symbol AAPL, is the most valued company at $3.4 trillion. With AI buzz, Nvidia valuation has skyrocketed, its value at $3.18 trillion. As I scroll down the list, you may recognize other companies. Dow Jones Industrial Average tracks 30 large blue chip companies. Notice the overlap? Apple, Microsoft, and Amazon are also on this index, along with other blue chip companies. Blue chip companies have great reputations, are well established, and are financially sound. The NASDAQ Composite Index contains 3,500 stocks listed on the NASDAQ Stocks Exchange. And again, you'll see the same companies at the top, but as you scroll down, most of the companies I don't recognize, and most likely you don't recognize either. When CNBC reports out on market performance, essentially they are reporting out on S&P 500 Index, Dow Jones Industrial Average, and NASDAQ, the grouping of like stocks. Companies' performance within the index causes the index price movement. In 401k plan, when it compared the fund's performance against the benchmark, it essentially compared to the index that the fund is either trying to mimic or trying to beat. The reason I bring up actively managed funds versus passively managed fund is the expense ratio. Actively managed fund has an expense ratio ranging between 0.25% to 1.15%, whereas a relatively low-cost passively managed fund has an expense ratio of 0.015% to 0.080%. Note that your expense ratio for passively managed versus actively managed may be higher or lower. I'm only going off based on the experience I have and the expense ratio I have seen over the years. The other three areas where you can spot passively managed fund that track and mimic the index is by the fund's name. It should have either index spelled out like FID 500 index or Vanguard INST index, or abbreviated like IDX, VANG, midcap, IDX, INST, or FID, MID, cap, IDX. They also have very low turnover rate percentage, about 15% or less, because they're not trying to beat the market by constantly buying and selling as often as the actively managed funds. In the funds index objective, it should state something along the line of track the performance of XYZ index, where XYZ is the name of the index. With higher fee, does it mean actively managed fund outperform the passively managed funds? Not so fast. Higher fees doesn't always translate to better performance. According to data from SPIVA report, S&P indices versus active published by Dow Jones Indices, over a 15-year period, 87.98% of actively managed fund underperform S&P 500 index. Only 12.02% of actively managed fund outperform the S&P 500 index. For the optimists out there who think they can do better than what the market can return by investing in actively managed fund, used to have a 12.02% chance of beating the index. But for you and I to pick the right funds for 10 to 15 years out, it's a loser's game. Can we get lucky? Yes. But we have a highly likelihood that we pick the wrong funds due to high funds manager turnover rate and other macroeconomic factors. For me to pick the right actively managed fund over a 15-year period, it's probably the same success rate or worse than ESPN analysts trying to predict who will be crowned the champion, or who will be the next dynasty, or who will be the next Michael Jordan. It's fun to watch, but I wouldn't put my paycheck on it. Who would have thought a 6th-round pick number 199 in 2000 NFL draft, will go on to play 23 years in NFL, bringing home 7 Super Bowl rings, and propel New England Patriots to a dynasty status. Go Blue. By the way, I'm not a Michigan fan or Michigan State fan. It's just something that I hear all the time in the office, so I just want to throw that out there. What about all those countless prospects that the so-called expert predict to be the next superstars that fell into the draft bust abyss? If we pretend for a second that professional teams is publicly owned and traded in the stock market, and the professional league is the index, instead of betting on what team will be the next dynasty, betting on the league to prosper is the winner's game. I grew up watching the 90s and 2000 basketball, where the Chicago Bulls, Los Angeles Lakers, and San Antonio Spurs were the teams that won multiple championships. In 2010 decade, it was the Golden State Warriors. Trying to pick who will win multiple championships over a decade out is hard. And trying to hold on to past decade winners is fool's errand. Legends, all-time greats come and go, but new stars are born, replacing the dying stars. Some players have long careers, some players have short-lived careers. Changes in front office from managers to coaches comes with vision, direction, and scheme changes. Over the last several decades, I have seen teams rise and fall. Regardless of what team rise at the top or fall to the bottom, the NBA continues to thrive. The same goes for the NFL and the MLB. In a roundabout way, that's how index funds work. It doesn't try to be fancy and try to pick the winners. It simply buys all the companies, team in the respective index professional league. Companies may fall out of the index, but new one will replace its spot. You may have companies that go bankrupt, losing 100% of their business, but you may also have companies that grow their value to 10x, 20x, and beyond. J.L. Collin calls this self-cleansing. I hope this sports analogy kind of makes sense. Having said all of that, if you're one of the lucky few that have a 401k plan that contains actively managed large growth fund, similar to what Dave Ramsey keeps bragging about, where it outperforms the market minus the expense ratio, by all means, take advantage of it. But for me, 26 years working career with 3 401k plan providers, with 3 companies, I have not come across an actively managed fund that outperformed the index over a long period of time. Now that you have basic understandings of the different components that make up the funds inside a 401k plan, I will deep dive into 2 stock funds, 2 bond funds, and 2 blended funds, essentially target date funds. As I'm going through the details of these funds, don't get too overwhelmed with all the different data that are available to you. Keep in mind, my intent of this series is not to make you a mechanic. It's to enable you to understand so that you're able to drive this investment vehicle forward. Your 401k funds provider website may have different look and feel, but the terminology and the different things that you should be looking for, what I will be discussing is something that you should be able to transfer to your funds providers. I want to look at Vanguard Institution Index, VINIX, which is a large cap fund. You get a better description of the funds at the top. This is Vanguard Institutional Index Fund, institutional shares, ticker symbol VINIX. It shows a NAV, net asset value, which is simply the fund's total asset, divided by the number of funds shares outstanding. When in doubt, you can always click the underlying word and it'll give you the definition. But more often than not, the definition will require even deeper research because of the language that they use. Net asset value is useful to know, but in this context, I don't pay attention to it. My 401k provider also offers Morningstar Snapshot with the fund's overall rating, returns, expenses or fees, and risk. Think of Morningstars as Kelley Blue Book or Edmund.com for the investment fund's rating. Under their performance, it shows 1 year, 3 years, 5 years, and 10 years return. You want to go over the fund's overview, where it highlights the fund's objective, strategy, risk, short-term redemption fee, who may want to invest the fund, additional disclosures, etc. This fund's objective is to track their performance of the S&P 500 index, mimicking the investment return of the large cap stocks. The fund strategy explains how it plans to achieve the objective. This fund strategy is to replicate the S&P 500 index by investing in all the stocks that make up the index by market cap weighted. The fund risk highlights the potential drawdowns. Growth stocks can be more volatile, while your stock can continue to be undervalued by the market, keyword by the market, for a long time. In the details section, this fund is a large blend fund. The fund inception date was July 31st, 1990. Expense ratio is very low at 0.035%, which means you pay 35 cents for every $1,000 invested. Very low turnover rate because this is an index fund. It doesn't try to beat the market. It simply mimic and copy the market. So when the market goes up, the fund goes up. When the S&P 500 goes down, the fund goes down to about the same rate. In this section, it lists the composition of the fund. Top 10 holding accounts for 34.32% of total portfolio. This fund contained 506 stocks holdings as of July 31st, 2004. Its top 10 holding accounts for 34.32% of total portfolio, and they are companies that most of us know and love. Apple, 6.9% of the fund contains Apple stock. 6.7% of fund contain Microsoft. 6.2% contains NVIDIA. 3.69% contain Amazon. And rounding off the list, 1.39% of the fund contains Tesla. If you want to see the full list of companies, you can click on the prospectus. Prospectus is a formal document required by the Securities and Exchange Commission, SEC, to inform the public, potential investors, details of the investment. My target audience is day zero, someone that wants to grow their wealth but had no experience in finance. So instead of reading through all these literature I would advise you to skip them unless you want them as a sleeping aid. Simply go to Portfolio Holdings. It breaks down the companies the fund owns and how many shares and market value. Imagine trying to manage this massive list on your own. Even though it is investing in 100% stocks, it is well diversified, spreading the money across top 500 US companies. Now you know why S&P 500 Index Fund is highly recommended by the expert, financial gurus, financial influencers, and even Warren Buffett.
We just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you.
The hypothetical growth shows the fund's performance compared to the benchmark. Since Vanguard Institutional Index Fund Institutional Shares is an index fund, also known as passively managed fund, tracking the S&P 500, and it's in a large blend category, this graph compares its performance against S&P 500 and large blend fund. It outperforms the large blend's average, and it is almost a carbon copy of the S&P 500 index. So much so, you can't even see the purple graph, but it is there, along with the light blue. It is how it should be, because this fund goes up and down the same rate as the S&P 500 index. Under performance and risk, average annual total returns of the fund, look at the fund that you're interested in. How does it compare to the benchmark, and how does it compare to the same category? Is it underperforming or is it outperforming? And also look at the 1 year, 3 years, 5 years, 10 years, and life of a fund. Average annual return is a nice quick glance, but to really see what goes on from year to year, if your provider provides it, I will go down to the calendar year total returns. This gives you a little bit better picture of how the fund performed from year to year. This way, you're not only happy when the fund is up, but you also prepare yourself for when the funds is down and how much the funds goes down. This fund, it has a nice solid return, and it went down negative 4.42% in 2018. And in 2022, it went down 18.14%. Because it is mimicking and tracking S&P 500, the return is almost identical to the benchmark. Next up is the composition tab, the breakdown of the different sectors that the fund invested in and the percentage. It is a large cap growth fund, and almost all the stocks are domestic stocks, which is essentially US stocks. And again, the top 10 holdings, the different region, mainly in the US. Let's go to fees and pricing. Always pay attention to this tab. What is the expense ratio? Because this one is an index fund, it's a very low expense ratio, 0.035%. Let's look at T. Rowe Price at a glance. Nice return. Expense ratio for T. Rowe Price is 0.7% versus Vanguard Index at 0.035%. Once you click on the fund's name, it gives you a full name of the fund, T. Rowe Price Blue Chip Growth Fund, ticker symbol TRBCX, net asset value 187.82, overall rating from Morningstar 3 out of 5, returns 3 out of 5, expense 2 out of 5, and the risk for the fund. It shows the 1 year, 3 year, 5 year, and 10-year return. Look at the fund's objective, which seeks long-term capital growth. Income is secondary objective. And if you read through the gibberish that it has on here, it's just essentially telling you that it's investing in large to medium-sized blue chip growth company. And go back up to the details. This is a large growth fund. The fund's inception date was June 30th, 1993. Expense ratio is 0.7%, so you pay $7 for every $1,000 you invest in the fund. Turnover rate is 9.8%, surprisingly fairly low for an actively managed fund. Here's the difference between what I looked at before, the Vanguard S&P 500 Index, the VINIX, to this one. If you look at this fund's composition, its top 10 holdings accounts for 63.41% of total portfolio. And this fund only has 82 holdings. 12.89% of the fund is invested in Microsoft stock. 12.23% is invested in NVIDIA, 8.19% is invested in Amazon, 8.13% in Apple, and rounding off the bottom two for the top 10 is 2.1% in MasterCard and 1.98% in ServiceNow. let's look at the prospectus, portfolio holdings. You see the full list of all the companies that this fund invested in. So this fund pretty much ride and die with these top 10 companies. If you're okay with 63.41% of total fund is in these top 10 holdings, then this may fit your bill. This may be the fund for you. And the reason this fund has been performing quite well for the year, you look at AI, artificial intelligence, it's been in the news lately, and you see almost all these top companies are AI players. Now, can AI be the next future? Who knows? If you look at the hypothetical growth, T. Rowe Price beat out S&P 500, but it outperformed the Russell 1000 Growth Index. Go to the Performance and Risk tab. It's enjoying a nice 1-year return, 5 years, 10 years, and life of the fund. For the calendar year return, pretty solid from year to year. In 2016, the return was only less than 1%. But it also had a nice return in 2017, almost 37%, 34.73 in 2020. In 2022, it went down as much as 38.6%. That's huge. But it made a nice return, a nice comeback in 2023, 49.36%, and so far in 2024, 22.04%. In the world of investing, we always talking about every time you lose, in this case, 38.6% down, it needs to make 38.6% to break even, and to make a profit, it needs to go above 38.60%. T. Rowe Price Blue Chip Fund and S&P 500, they pretty much trade blows from year to year. Some year, S&P 500 outperform T. Rowe Price Fund. Other year, T. Rowe Price outperformed S&P 500. The lead changes hand year over year. But because T. Rowe Price is highly concentrated with the top 10 holdings, whereas S&P 500 is market weighted based on the market cap, it's not as highly concentrated. When the market went down in 2022, it didn't go down as much. That is one thing to keep in mind. You also want to look at fees and pricing. So this fund, to enjoy that nice return, you pay 0.7% in expense ratio. Out of $1,000 invested, you pay $7. Next up, let's take a look at one of the bond fund. When you click on this bond fund, VBTIX, it's a Vanguard Total Bond Market Index Fund institutional shares. The same look and feel, net asset value, Morningstar rating, performance for 1 year, 3 years, 5 years, and 10 years. If you look at the bond strategy, if you read the objective and you read the strategy, when I first read this, I did not understand what it means. And unfortunately, even if you read the objective and strategy, if you have not had any exposure to investing world, you will still be kind of like, what are you talking about? The investment seeks to track the performance of the Bloomberg US Aggregate Float Adjusted Index. Foreign language, right? Even though reading through this is gibberish, it will start to make sense once I go over different data points. This bond fund is an intermediate bond, which means that it should hold bonds with terms of between 4 and 10 years, which is, if you look at the duration of the bond, is 5.97 years. Weighted average maturity of the fund is about 8.4 years. This 30-day yield is useful to compare between two bond funds. This fund started on December 11, 1986. Expense ratio is very low at 0.035%. Under average annual total return, its 1-year return is fairly respectable for bond, but it has been hit quite hard for the 3-year, 5 years, and even 10 years. Like I mentioned in the bond section, the longer the term, the more sensitive it is to interest rate change. The high inflation that we have been experiencing, the high interest rate, it doesn't help the bond case at all. Under composition, you want to look at the credit quality. This bond fund invests in investment grade bonds, BBB and better, and it's highly concentrated in AAA. That's very awesome. And no concentration for anything under investment grade. In other words, junk bonds. fantastic. Their top 10 holding consists of U.S. Treasury notes. That's as safe as it can get because the government can always print more money. And it's very diversified. Its top 10 holding only account for 4.23% of the portfolio, over 17,000 bonds. But I'm not going to bore you with all this. And the breakdown is concentrated in government bonds, and then corporate bonds and agency mortgage-backed. In summary, this bond is an intermediate bond containing bonds with duration of just under 6 years, with a weighted average maturity of 8.4 years, with its 30-day yield of 4.48%. It is well diversified, investing in high-grade corporate and government bonds. Let's look at another bond investment, Dodge and Cox Income. What is the fund's objective? The investment seeks a high and stable rate of current income consistent with long-term preservative capital. Details of the fund. This is an intermediate bond. This fund started on January 3rd, 1989. The expense ratio is very high at 0.41%. It has a 30-day yield of 4.75%. The duration of the fund, it's around 6.22 years. The weighted average maturity is just under 10 years. And one thing to note, the higher the duration, the more sensitive it is to interest rate change. You look at the composition, its top 10 holding accounts for 15.21% of the portfolio. It only contains 1,388 funds compared to the other bond that we just looked at. Under credit rating, it invests majority of it in investment grade bonds with some exposure to junk bonds. Instead of highly concentrated in the government and corporate bond, this one is highly concentrated in agency mortgage-backed bonds, 43.31%, and 31.2% in corporate bonds, and only 15.01% in government bond. This makes sense. It does have some exposure to bonds outside of the United States, so it is a little bit riskier, but in return, you also have a little bit higher returns than the other bond funds. I want to just show the last bond is not my 401k plan, but is in a different plan. As stated in the bond section, if you see bond fund that have a higher yield than usual, I would be really cautious about it and look at the composition of that bond fund. PGIM High Yield Z, ticker symbol PHYZX. It has a pretty good return, but let's look at the fees. 0.51% is pretty high. Let's take a look at the composition on why this bond fund is a high yield bond. The category is a high yield bond. Expense ratio is 0.51%. Its 30-day yield is pretty high at 7.27. Average coupon is 6.35%. Duration is only 3.14, so it's a short-term bond. Weighted average maturity is under 5 years. Let's look at the objective. Seeks to maximize current income and capital appreciation is secondary. Let's see, why does it return so much? Let's look at the composition. Oh yeah, almost 81% in corporate bonds, under 6% in government bonds. And this fund contains low credit rating, so that's not good. There we go. When you see bond funds that have high yield than usual, pay attention to the credit quality. It invests a lot in junk bonds, very little in high quality investment grade bonds. And the fees to have that high return is 0.51%. And this is entirely up to you. Are you willing to chase these high returns, paying these high expense ratio, knowing that the bonds funds consist of mainly corporate bonds, very little government bond with low credit quality rating? That's only you can answer that. The last two funds I'm going to look at are target date funds. They are classified under blended fund investments. This Fidelity Freedom Index 2015 institutional premium fund is targeting 2015 retirement year. And this Fidelity Freedom Index 2065 institutional premium fund is targeting those who retire in 2065. I'm going to show you the 2025 target date fund and the 2045 target date fund just to show you the different compositions. and the different asset allocation. If you look at 2025, its 1 year return is 10.73%. Its 3 years return is 1.4%. Its 5 years is 6.12%, and life of the fund is 6.16%. 2045, further out, its return is a little bit higher, 15.12 for the 1 year, 4.31 for the 3 years, 9.851 for the 5 years, and 8.66. Notice from 2045 and beyond, look at the return, well over 8.6% as you go further out. But as you look at funds that are closer toward the target year, you see that the fund's returns get less and less and less, which makes sense. Like I discussed before, target date fund diversified between US stock, international stocks, and bonds, and it shifts the allocation based on the target year. Let's look at the composition for 2025. This is a Fidelity Freedom Index 2025 Institutional Premium Class. This is a target date fund 2025. This fund started on October 2nd, 2009. Expense ratio is very low at 0.08%. It underperformed S&P 500 by a mile, which makes sense because it's diversified and it's 2025. So it's going to shift more toward a conservative bond. You look at asset allocation, it's well diversified, 31.51% in US stocks, 21.16% in international stocks. Essentially, that's what it means, ex-US, excluding US. 21.16% in international stocks, and a whopping 47.24% in bonds. If you look at the fund's objective, seeks high total return until the target retirement date. Thereafter, the fund's objective will seek to have high current income as a secondary objective, capital appreciation. When you buy into a target date fund, just know that you are not going to be able to beat a pure stock like S&P 500. But that's the trade-off you get for that peace of mind, right? Took a look at their performance, 1 year return, 3 years, 5 years, 10 years, and life of the fund. Take a look at the calendar year, how it performs from year to year. It's not going to have a high return of 31.49% like you see in one S&P 500 index. But at the same time, you're not going to see a big dip like you would see when we had in 2022. Under the composition, it's a large cap stock aiming for growth. Because it has a bond component, it also shows the credit rating, high credit rating, and the sensitivity to interest rate. Let's take a look at the prospectus. Look at the monthly holding report. This actually provides even better detail. You look at the full holding, U.S. equities, the fund, Fidelity Series Total Market Index Fund, 32.29% of the asset. And you can see the actual ticker symbol that you can use to do more research on. But target date 2025, because it's essentially 1 year away from that target year, this target date fund shifted more toward bonds and less with stocks at the expense of returns. Let's look at 2045. This is a Fidelity Freedom Index 2045 Fund Institutional Premium Class. Ticker symbol FFOPX. And it states here, target date 2045. This fund started on October 2nd, 2009. Expense ratio is very low at 0.08%. And again, its return is going to underperform the S&P 500, which is pure US stock market. Asset allocation, because this is 14 years out, it's going to be more aggressive. It's heavily weighted toward stocks and less toward bonds. 53.83% in US stocks, 36.14% in international stocks, and only 10.01% in bonds. And you can read through the strategy, pretty generic. Because it has more stock component in it, you see that its performance may not be as close, may not be beating the S&P 500, but it's a little bit closer than the target date 2025. Under performance and risk, average annual total returns, pretty solid year, not too bad. In the investment world, if you get between 8 and 10%, call it good. Look at the calendar year return. Even though this is well diversified between US stock, international stocks, and bonds, because it's heavily in stocks, both in international and US, it has almost the same volatility as a 100% in S&P 500. It doesn't have as much in terms of rate of return, not as high as S&P 500, But when the market dipped in 2022, it went down as much as the US stock market, 18.20%. Let's look at the composition tab. Currently, it's in large cap and it's aiming for growth, which makes sense. And if you look at its bond element, it's investing in high quality rating bonds and intermediate bonds, which is sensitive to interest rate changes. In summary, for target date fund, all you need to look at out of all the list of target date fund, choose the funds that are closer toward the year that you plan on retiring. What is the expense ratio? The composition of the fund. This stable fund is listed as a bond investment, but it's classified stable value. I don't touch this. This has a better return, slightly better return than money market, but doesn't have the same volatility as bonds and stocks. But this is super, super conservative and essentially give you these return without any capital appreciation. It's always staying at that $1. Unless you just want to preserve your portfolio, this is something that I don't look at. This is something I don't think I ever have in my portfolio. If this is something you're interested in, feel free to research on your own. I won't be discussing anything about stable fund. To recap the list of 401k fund, your plan may have different look and feel, but mine is under investment tab. Under investment tab, it'll show you that I have 31 funds, 31 options to choose from. And under that, it shows me a list of all the funds that are available. At least for my user interface, it does a pretty good job of grouping under asset class, whether it's stocks, blended fund, or bond investment. And also group it by category, whether it's large cap, mid cap, small cap, or international. It gives a pretty nice summary, 1 year, 3 years, 5 years, 10 years of life of the fund. When you pick the fund, don't simply go for this year's winner or last 3 years winner or last 15 years winner. Look at the life of the fund as much as you can, because this year's winner can be last year's losers and vice versa. Once you look at the returns, look at the expense ratio as well. Here's the homework for you before the next episode. Taking what you have learned so far, at first glance, look at the list of available funds. Look at the different type of asset class and the category. If you're interested in strictly stock investment, is it just large cap, just mid cap, just small cap, or a combination of them? It doesn't matter. Which one you are interested in investing, which one are your top based on your risk profile. Compare and contrast the returns for 1, 3, 5, and 10-year return minus the expense ratio. That will determine which one should be your top fund. Make note of the ticker symbol. And in the next episode, we'll use those ticker symbol to go beyond just the 10-year returns that your 401k plan provides. In the first episode, you know how to align the fund's performance and risk profile to your risk profile. In this second episode, financial terms like should not be common words for you. Now that you're able to read and understand the information provided by your 401k fund provider, in the third and last installment to this series designed to help you pick the right 401k fund for you, I will go over 2 awesome free tools that you can use to backtest a fund or combination of funds to make up your 401k portfolio. 401k investment is a 4-quarter game spanning across 3 to 4 decades. Don't get too hyped up on the funds that perform well in the last year, the last 3 years, the last 5 years, even the last decade. And don't get too down on the fund that hasn't been performing well either. Don't simply pick funds that are winners for this year, last 5 years, or even the last decade. Just like in sport, lead changes hands throughout the game, and championship team changes throughout the decades. What matters is you come prepared with a game plan, carry on that game plan, take it one step at a time, and trust the process. Different teams with different coaches dominates different decades. Different funds with different funds managers dominates different decades. Contrary to what you see on the news, what you see on social media, no one can predict what's going to happen 10 plus years out. Last decade winners can be the next decade losers, and vice versa. Stick to the game plan by selecting the fund based on the asset allocation, and low fees to maximize your returns while mitigating risk and aligning it with your risk profile. Lastly, If you believe in the mission of making finance and investing easily understood and accessible by all, not just the top 1%, please like, comment, subscribe, and share so YouTube algorithm can push this to more people.